management is a very interesting subject. What is this financial management? What does it deal with? What is its importance? In the first running lecture, I am not going specifically like exam question to answer. I will give you a brief idea in the form of a small discussion so that you have a clear picture about the importance and interesting issues in that. What is this finance management? Finance management is management of funds. It simply deals with management of funds. We have seen accounts, financial accounts aim at preparation of, they have to prepare the financial statements. Costing is basically aiming at cost control, cost ascertainment, cost control, cost reduction, and then providing information to management for decision making. Then finance management, if you ask in one word, it's to do with effective utilization of money, effective utilization of funds. What do you mean by utilization, effective utilization? There are two aspects to the fund management. One is procurement of funds. Procurement of funds means you're raising money. And then utilization. Why do you need money? We have to use money for purchasing of assets, land, building, machinery, etc. And also running the day-to-day operations. The whole object of this management is when you are using money, you are expecting some return. And when you are raising funds, you have cost. So the return should be always more than the cost of funds. That is the purpose of business. That is the result of that is you earn profits, you create wealth, and you create value to the shareholders. This is the broad view. So in other words, you please refer to the first chart I put before you. The function, finance management, function, procurement of funds, then applications, utilization of funds. This is called function. What you do? Then, in that procurement of funds, we have to apply your mind. Application of mind means you have to take the factors that are going to, what are the factors that are going to influence our decision? Factor number one, whenever you are raising money, cost of raising the funds. You always want to have funds with cheaper rate of interest. Cost should be cheaper, servicing them should be less. Second point is control. Whenever you raise funds, broadly funds can be segregated into, here our discussion is about long-term funds. Long-term funds means where the business, the funds are kept in the business for a period more than a year, and generally about 3 to 5 years. So broadly we understand, there is no hard and fast rule. Less than a year is called a short term. Above 1 year and below 3 years is called as medium term. Above 3 years it's called as long term. Here the importance of this nature of funds is, if suppose I take fixed deposits, 100 lakhs I have taken via fixed deposits, promising to pay an interest of 12%. What is the condition attached to the fixed deposits? We have to pay the interest. Yes, we are ready to pay the interest. Monthly we can pay, periodically. Fine. Second is, whenever they ask, I should be in a position to pay back that loan. Whenever they ask, I should be in a position to pay back the loan. So I have taken, this is the nature of funds which have been raised. That is called short term. Now what is the purpose of, how do you use these short term funds? Suppose I purchase a building with that. Or suppose I buy a machinery with that money. Do you think it's right? The point will be, after 3 months they will come and ask us to pay back that 100 lakhs. Then what you'll do? Will you sell the machinery? The purpose of buying the machinery is to produce goods, make profit and repay. But if you want to sell the fixed asset in a short time, you will not be able to sell, first of all. Point number 2, you will not be able to realize the price. Therefore, the basic rule of finance is never use short-term funds on long-term applications. If you analyze all the leading companies which have gone into liquidation, and in fact if you analyze most of the finance companies, the owners or proprietors or promoters are all in jails now. Simply what they have done is they have borrowed short-term funds and put them in the long-term applications. When the business went into crisis, they collapsed. So therefore, first and foremost step is we would like to know the nature of funds, whether we short-term funds or long-term funds required. That means we need to know what are we going to do with the funds raised. Are we going to invest in fixed assets, or are we going to invest in working capital? Working capital, I mean current assets, that is funds required to be invested, blocked in raw materials, spares, finished goods, work in progress, debtors, and you need to maintain minimum cash balance. So short-term funds should be used only for short-term applications. This is the basic postulate of finance management, you can say. So one is basically the cost, that is the strings attached to the source, and then the control aspect is risk is there. That's what I've talked about. If you take, well, let's briefly talk about the long-term funds nature. We can broadly classify them into equity and debt. So I want 100 lakhs. I can raise 100 lakhs in the form of equity share capital. So I will issue shares. Take for example Tata Steel. Recently in June 2008, they have issued recently the rights issue. The share price was around 800 rupees. 10 rupees share is being traded at 800 rupees. Very good performance of the company. But the shares have been issued at 300 rupees. Right shares were issued at 300 rupees. That means a premium of 290 per share. 10 rupee share, face value, 290 rupees is the premium. And many people applied. Suppose a person was having, let us say, 100 and 200 shares, 2000 shares. He was given 410 shares, something like that, at 300. Many people have applied for 600 shares, but the company issued only 410 shares. And the shares are just oversubscribed. No, but they were not willing to give it any extra. But why did the people subscribe to Tata Steel? Here, because Tata Steel is a proven company with a very good management, excellent profits, all these things. The track record is simply excellent. And the market price was at 800, they have issued at 300. But mainly, the shareholder was very much interested in the dividends. They were paying 13 rupees per share every year promptly on July or August. And they will be issuing, the share price will be appreciating without doubt. So an average shareholder is highly influenced by the share because the return is very high. For them, 10 rupees share they are issuing at, they are giving a dividend of 13 rupees means 130% dividend. So the cost of dividends, the cost of servicing the shareholder is very high. Another important point is the equity dividend will not be allowed as deduction for tax purpose. So, taking these two views, but the advantage of equity issue is that you need not pay dividend if there is no profits and there is no ultimatum for you to return the share capital. So that way equity shares have no risk. But the point is, nobody gives you money when the track record of the company is not paying dividends and going in for liquidation. Nobody will be paying their hard-earned money. Nobody will be investing their hard-earned money. So therefore, companies have to perform and have to pay high rate of dividends, and then only equity shares will be attractive for the investors. So that means one is rate of expectations of shareholders very high, that is cost, and two, it is not allowed as deduction for tax purpose. So therefore the effective cost of equity is most normal rate you could take more than 24% for the company. Whereas if you take a debentures, the rate of debentures may be 10%, 9% interest. Suppose I raise 100 lakhs in debentures, my cost is just 9 lakhs, and the interest on debentures is allowed as deduction for tax purpose. So if it is allowed as deduction for tax purpose, means that the effective cost of interest will be much lesser after tax. Suppose the rate of dividend is debenture interest is 10%, the rate of tax is 40%. The effective cost of debentures is 6%. That is 10% into 1 minus 40, 60%. But then the problem with debentures is that whether the company earns profits or not, you have to pay interest. And once you promise that debentures are promised that they will be paid after 5 years or 3 years, and therefore we should be ready, we should have sufficient funds to pay them back. To that extent, risk is high. So I hope you understand that cost of funds and risk go together. So as a finance manager, the option is not just borrow whatever you like, because the shareholders are also watching you. You can't indiscriminately borrow. That means the riskiness of the company increases. Thereby the importance given by the investor to the particular share falls. A risky company will have low valuations. So that also we have to take. So in other words, the finance manager must think of all the parameters. Suppose one more point to explain is the control. With regard to control, if you take debenture holders, there is no problem because they will not interfere in the management so long as you pay their interest in time. But in case of equity shareholders, more number of shareholders coming will dilute the controlling power of the existing shareholders. Suppose I am holding 51% shares in a company, so then I can decide how to run the company. Now I need money and I issued shares, because of which my control has come to 30%, and somebody has taken over 51%. Then I have to sit and listen to what they say. So that nobody will like to do it. So therefore, friends, when you are raising money, it is not as simple as you just borrow money and then run away. No. A decent corporate entity, when it raises funds, it must remember the funds are attached with some strings. One is cost, you have to service them. And you have to choose the cost minimum. Then you have risk. The risk in terms of payment of servicing the source of finance, and also repayment due dates. And control aspects very, very important. Control is very important. So other considerations particular to the firm, but these are the prime considerations. But the net is, the funds have a cost. We are supposed to find out what is the cost of the borrowing, effective cost. Right, this side is cost. Once I have taken 100 crores for financing, running the business, and I determine the cost to be 20%, the meter stops. So as the period goes on, I have to pay interest. No choice for us. And applications. Applications. Why do you need funds? Because once you take funds, the meter starts. So you have to earn a return. You can't take for 20% loan and then put it in a current account. And so we have to perform. We have to invest very shrewdly, and we have to take charge of the opportunities which are prone to risk. And successful investment analysis strategy is very important. So one is fixed assets management. So when you need money only for investing in the assets. These fixed assets are basically used to produce goods and revenues. And two, when you have machines, when you have land and buildings, factories, for what? You have to produce goods. So we have to buy, suppose it's a sugar industry. I have had invested almost 500 lakh crores. So I need to procure raw material, sugar cane, and then store it. So the daily production, I don't search anywhere. The raw material is there. I have to invest money on that sufficiently. I have to construct stores and put them. Similarly, machines get worn out. Stores and spares, I have to invest. Then the goods are produced, and to sell, I said before you sell, you need to store them. Whenever the customer comes, you have to pay. You must have stock sufficient to take care of his interest, needs, demand. And when you sell the goods, you may not be able to cover the money. So we need funds to run. This is called working capital management, which we are going to discuss in detail. So finally, at the end of the day, you have to earn a return which is more than the cost of capital first to survive in the business. And then you have to earn maximum return so that you can continuously build, create wealth. This is the issue. Business is done not for charity, business is done to earn profits. This is the first part, friends. You see the chart. This is procurement of funds, the effective utilization. Now, whatever we do, we should have a clear-cut goal. Whatever you do, we should have a clear-cut goal. For example, we are coming out with DVDs. Our object is to spread the message of education throughout the country, so that people who can read, who cannot read, you cannot read by reading the books. It is a convenient form of learning, so that I end up doing some service. At the same time, I would expect that if the if the lecture is found to be useful, I might become popular. And since I am writing books, I have written books, so students may be interested to purchase the books. These are all the basic focus. Nobody does. It's clear goals. It is a defined goals with which we are going to come up with. According to the goal only, you will produce the product. So the question before us is, why should you do business? Everybody can ask, why do business makes profit? So now the question is, profit maximization is the goal of business. Is profit maximization is the goal of business the question? One way of answering is yes. If the business doesn't run well, if there is no profits, why should you do business? Why should you put your efforts? We come across every person talking so many things, but unless you are Mahatma Gandhi, the ultimate object of business is earning profits. So let us accept profit maximization is the goal of business? No. Even you take, for example, government of India buys oil. When the oil prices go up, they immediately raise the prices because they are buying at high cost. They cannot subsidize. They will do some subsidy, but not to the extent they lose badly, requiring the budgetary support. But after that, you know that recently the petrol has gone up to $147 per barrel. But government has immediately increased the price. But when the price has fallen to $40 per barrel, the government has reduced very little. The reason is when the prices were very high, oil companies were taking a big beating. They were incurring too much losses. So now it is, let us give them some chance to recover all the losses and also make some buffer, because tomorrow we don't know what will happen. People will be impatient if you raise the prices. So therefore, the government on a long-term objective would have decided to reduce it in stages. That is a prudent finance policy. Let's go back to our original discussion. Is profit maximization the goal of the object? So whatever I discussed is in favor of that. But when I say profit, say for example, you join my classes. A CA coaching class is basically, CA classes are very simple subjects, but the students believe that it's very difficult to pass. Because of this particular feature, the students are not able to, that fear is there in their mind. And then they go to, let us say, a very reputed coaching center where they sit among 200 students. And a lot of intelligent students sitting, asking questions, talking big things. And this average student is finished. And that is the reason why there are a lot of failures in CAs. He develops some sort of a fear about the subject. Therefore, when the student joins, he must be in a position to analyze what he wants and whether he gets what he wants. Accordingly, they should join. So, this is called as what's called as stakeholders. When I take profit, I take the student, I charge the fees, and I just teach mechanical and send them out. That will not take him anyway. That is called profit maximization. Ignoring the interest of stakeholders and running the business. For example, a question was asked to Narayana Murthy ji, the doyen of the Indian software business, a great leader who has brought name to India, branded India as a knowledge warehouse. So, this gentleman, when he is asked question, whom do you rate them first among the stakeholders? Stakeholders means shareholders, because they provide you money to run the business. Then creditors, they also provide you money for running the business. Then government, society, customers, employees. All these parties are interested for everything we talk about Infosys or Tata Steel or Ambani's, because we have a lot of expectations. He said, first I will rate customers. Customers is the number one for me, because the purpose of business is the customer. Mahatma Gandhi was the first person who was already advised, you must treat customer as a king, because he is the God. The purpose of business is the customer. Unless he is satisfied, where is the need for doing the business? So he said, today it is because of him I get revenue. I get my revenue. Therefore, I have to work towards satisfying the customer. 1. 2. Employees. Suppose I am running a coaching center. First, the students are the main. Their success is my success. I must put all my best efforts to make sure that they are very successful. Otherwise, what is the purpose of business? Now once I satisfy them thoroughly, as Infosys has done, as Tatas have done, then comes to make them happy, we have to produce a product, serve them, then employees. Number 2, priority goes to employees. They should be highly motivated employees. In Tata Steel, Tata Hotels recently, we know the terrorists have struck the Bombay Taj Hotel belonging to Tatas. One officer lost his wife and children. And Ratan Tata went to meet him. He was saying that we will all work to rebuild our Taj spirit. It is the highest form of devotion to the management. That means how careful the management will be nurturing these people. And the entire success of the Tatas must be because of the employees. This is what Ratan Tata has mentioned. And that once you are able to create an atmosphere and motivate the employees, your goals are achieved. That is, second is employees. Third one is the shareholders. Of course, shareholders I think we'll put it a little later, because finally, unless we take all the stakeholders into consideration, the object of profit maximization will not be achieved. So friend, there are two types of profit maximization. Profit maximization, as you understand, from the narrow angle. Narrow angle means, take Ambassador car company. The Ambassador car is as old as 100 years. But the same type of product was produced in all the 100 years. In other words, the Ambassador car today is same as what it was 100 years ago. 2. The quality of the car, every new product was deteriorating. At the same time, price was increasing. They were not bothered about the employees, and they, in spite of the greatest advantage, Ambassador and Fiat car, these and Herald car, Standard Motors, these are the only three companies which were allowed to produce cars. The government did not allow anybody to produce cars. Now once the competition came, they were thrown out. Fiat car and all, nobody would like to buy the car. For 6 months once one car is being sold. So the company has gone into terrible losses. Because, why? What is the reason? They were having advantage of government patronage. They were only the people to market to the huge demand in this country. But then they ignored the interest of the customer. Same old product, low quality, high prices. They just ignored the customer. 2. Highly demotivated employees with not good salaries. Then what happened? Once the competition came, they could not survive the game and they lost it. In other words, profit maximization, if you ignore the interest of all the stakeholders and then do the business, then naturally it is not going to survive. Then what type of goal I should create? Now we have decided that profit maximization is not the issue. It's not the right thing. The next is wealth maximization. Wealth maximization. What is wealth maximization? Simply earning profits by taking into consideration the interest of all the stakeholders. Tatas are reporting huge profits. Infosys reports quarter to quarter, lot of profit. So profit making is not wrong, but you should earn profit by taking into consideration the interest of all the stakeholders. That is important. That is most important. So therefore, I am sure you agree that wealth maximization is far superior than the profit maximization. So what is profit maximization? Then think of Infosys. What a Ambassador car. And wealth maximization is all the reputed companies like Infosys, Tatas and others. Then what is the final goal? Shall we stand at wealth maximization? Yes, wealth maximization is the ultimate goal of the management. But then, companies are created by whom? Companies are created by shareholders, because they are the people who are giving money. Suppose you want to start a project, you need money. And if somebody is giving money, they are the people who are initiating. I may have great talents, but I don't have money, then where is the question of starting a business? And therefore, shareholders are ultimate promoters who take risk. They provide money for us, for the corporate entity. How will you be benefited as a shareholder? A shareholder cannot go to the company. If I suppose I am holding 100 shares in Taj Hotels, I cannot go and sit and eat freely. I have certain rights for that 100 shares. They will give me dividends, and the share price is expected to go up. So I will be very happy if I bought a share at 300. The share is going in 1 year to 600. Oh, my return has appreciated by 100%. I am very happy. Therefore, ultimately whatever the company does, it should finally benefit the shareholder. How the benefit to the shareholder is by way of appreciation in the share price. Of course, the companies give dividends. Take for example, Tata Steel 10 rupee share is giving, will get you 13 rupees dividend. Suppose if I am having 1000 shares of Tata Steel, I will get 13,000 as dividend. But my effective return is not 13% because the share is at 800 rupees. I have paid 8 lakhs, 800 into 1000, 800,000, 8 lakhs to purchase the share, and I got only 13,000 rupees. What is my rate of return? It's not even 1.5%. So therefore, every investor would like the share to appreciate, and that is called as value maximization. So ultimately, dear friends, you should be clear that the object of finance management is value maximization. Please be very clear on that. Profit maximization, wealth maximization, value maximization. There is a difference. There is a difference. Profit maximization without taking into consideration the interest of the stakeholders, then it is not going to be long term. Take for example, the prawn culture was there in India, and that time the government used to give 1 acre at 5,000 rupees near the sea, and prawn harvesting was very profitable. But there was a rule that after every harvest you need leave 3 months. You should not produce prawns. But people, out of their greed, they didn't bother. As a result, some virus came and wiped out all the farms, prawn farms in India. Therefore, that is called as greed. Ignoring the rules of the business, it will not work long term. That is what we should see. So that is what I have explained first. Please go through the chart. And finance management, point number 2. It is very easy we talk about lecture, you have to use money like this, you have to earn return which is more than cost of employee funds. But that is a very, very difficult game, because business is prone to uncertainty. You take this nation, unpredictable scenarios. Nobody can predict what's going to happen tomorrow. Over this 2008, if you take, we started the year with in February, excellent. All the parameters are very good. And we were aiming for a 9% growth in our GDP. India is a success story. We have discussed this elsewhere. And suddenly you found that in January, June, the inflation has gone to 12-13%. The government is about to fall. The oil prices have touched $147. Everywhere problems. Uncertainty. Slowly that started being controlled. Suddenly we have Bombay blast. And now how the India is going to respond, whether they are going to take a military option, causing great, but we are insulted, we have to do something, but we should force America and other world nations to punish Pakistan rather than we taking that. So, but then we don't know what's going to happen. If the things go calmly, then I think we will again grow very well. The world has gone into recession, so people who are earning lakhs of rupees have lost the jobs. So business is so uncertain, one cannot predict. We cannot expect everything will go fine. If everything goes fine, there is no need for decision making. So you do business only, make huge profits, enjoy. But it's not the case. We have seen in Chennai and all, people were running in crores of rupees. As you are aware of Anubhav foundations or many investment companies where the proprietors were only using 3-4 Mercedes-Benz cars are in jail for about almost 10 years till now. So therefore a business is not so simple. So we have to look it from that angle of what we are going to learn. You should look it from the practical angle. Dear friends, in this finance management you don't have many changes, in the sense you don't have varieties of problems like costing. But then understanding the essence of the business, if you make your moves proper, then you will grow from strength to strength. And if you make wrong moves, then what you are doing well, you will get wiped out. And therefore, business, you have to continuously watch the business. You have to be cautious, you have to be careful, and you should be determined in terms of difficult times. That is why CAs are very good businessmen, because they will take too much beating in the exams, uncertainty, they don't know why they fail and how to pass. They go here and there, run jumps up and down, but finally when they start doing profession, carrying on profession or business, they are the most successful people, which we will talk about it a bit later. Now I would like to tell you that you remember that bad production management, you may lose few lakhs, and bad sales management you may lose few millions, but bad finance management you lose the entire business. Take for example the American companies like James companies, where we were day in and day out, all the consultants were talking about Lehman Brothers, this company, America is a success story. Today every company gone to doldrums. Citibank, this, that, which were recruiting people with crores of rupees salary, they are nowhere to be seen, and resulting in the economic recession. Why? Because they have not followed the fundamental principles of business finance. I'll give you another example which you may not be aware, that at one point in time in Chennai, people were promising all kinds of things for borrowing loans. Fixed deposit were as high as 4% loans they promised, gold coins. People out of their greed, as Mahatma Gandhi said, there is a need, we have sufficient to meet the needs of the persons but not their greeds. All money they put it in fixed deposits of these small companies. When so many companies were promising 48% return, TVS company did not, they went with rules of the government. Now you can see the company is going steadily, perfectly, whereas all these mushroomed finance companies, proprietors either ran away or they are in jails. And the poor investors have lost all their hard-earned money. It's all because of the greed. The same thing happened in share market also. There were so many scams came and then affected the investors who have become penniless. So therefore, remember, money management is not so simple, it's very risky. So that is the first part of our discussion. Dear friends, my DVD is going to be a general lecture which is going to be very useful for you to understanding the essence of the subject. But another thing is we are trying to put the theory, what is this, what is that, and types of things. I would request you to just go through them. And in examination, don't by heart and reproduce it. You answer to points. Wherever possible, you have to give examples. So this is the basic introduction to the finance management, and I have explained one, what is finance function. Finance function deals with 1. Procurement of funds, 2. Their effective utilization. Second, the factor that should be considered in this is, when you are using the money, you expect return. When you are raising money, you have a cost. So the return should always be more than the cost of employing the funds. The return should always be more than the cost of deploying the funds. That is the essence of business. And the maximum, you have to make huge profits. And when you are raising funds, you are expected to look after the certain factors like one, cost of borrowing, risk attached to the funds, and then control aspects. When you are investing, again there are a lot of risks are there, investment analysis, capital budgeting, working capital management. It has its own features of management which we are going to discuss. That we have explained. Second point is, finance management deals with two aspects. Procurement, that is goal. Why do you do? Whatever we do, we have a goal. If you take a CA, many students we find, they don't know whether they should write both groups or one group. The decision should be born out why I should write both groups. You have answered. Why I should only write one group? What are my goals? It will be driven by goals. That is point one. So similarly, if you want to achieve the goal, what is the route? What is the path? So everything that we are going to take up must be perfect, and that you should ask questions to get it. That is why we ask the question, why should we do business? We do business because, one, we have to achieve the maximization of profits. Maximization of profits is plus and minus we have discussed, and finally we have decided that profit maximization must be supported by taking care of the stakeholders, and that is called as wealth maximization. Profit maximization is a short-term goal, whereas wealth maximization is a long-term goal. But more than wealth maximization, finally we have agreed value maximization as the goal of the finance management. So if you are asked one question, your answer is, what is the object of finance management? Value maximization. We finished. Value maximization means you have to ensure that the share price increases. Maximization of value of the firm so that the shareholder, the ultimate provider of funds, is benefited. So we have put the certain questions here. You please go through, don't read in terms of points, this, that and all, nobody is interested, because you will get 2 marks or 1 mark question. Why we should procurement of funds? What are the factors? So, but then for the purpose of notes we have given, they are basically taken out of the CA, ICAA Institute materials. So therefore this is for you to write in the exam, but the essence is what has been explained by us here. Okay, so let's continue the first part of the discussion, and the questions are what is the finance management and basic issues. Question number 1 we have answered. The scope and significance of finance management we have brought out, and let's take the topic 1, that is leverage analysis. What are these risks? Business means risk, especially when you put out your money. Funds management is totally concerned with risk management. Suppose you want to start a business. Once you decide to go in for business, that means you have committed certain costs which are payable every month. Suppose I want to open a branch in, let us say, Bangalore. I have to take a place. I have to pay the rent. I have to appoint some staff, manager and assistants, their salary, telephone, advertisement. These are all the expenditure I have to incur. Whether the students come or not, we have to incur this. That is called as also fixed costs. So this, you are taking risk. If nothing, nobody comes, no sales, no revenue, then the entire fixed cost will be loss, will be a loss. Therefore, this risk we have to measure. How do you go about it? For example, we would like to have a normal classes conducted in a school, and the cost of rent will be less. Or you can also conduct it in an air-conditioned room, give massive advertisement, bring in top big names. That also is possible. It's the way you are planning to do. And if you are going to do in a big scale, then there will be cost is fixed cost is very big. Then you will have to attract more number of students to cover the fixed cost. On the other hand, you want to do it in a school or just manage it within a particular level, then to that extent your risk is less. For example, you take an MBA institution and they will have a very big place, computers, so many high class staff, so much of salary. they'll also give advertisements, but then they'll charge too much fees. So finally it is a decision that we have to take, and that fixed cost, the risk that arises because of fixed cost, is known as business risk. It is an uncontrollable risk, and so that is measured by what's called as operating leverage. Operating leverage arises because of the incidence of fixed cost. It is an uncontrollable risk, and the formulas before I explain you, you can understand with the income statement. But we understand in a business what we are trying to talk. There are two types of risks. The risk that arises because of fixed cost just now discussed is known as the operating leverage. But a risk is always a degree. So you have degree of operating leverage. Now when we go to the next level, you need funds to advertise or all these things. Suppose you need 5 lakhs to establish a coaching center in a place. How will you finance the 5 lakhs? Fund them. It's possible you may borrow money. That means you have to pay interest. And suppose you want to bring in equity capital, that also you have to service them. So therefore, that interest risk, finance risk it is called as. It is a controllable risk. If you want to borrow, you borrow only, you have to pay the interest. So therefore it is called as financial risk and measured by degree of financial leverage. So in every business the two risks will always be there, and this is known as, both together is known as combined leverage. That's what we are going to discuss. So please see the chart. I have summarized that. One is a risk arising on account of fixed cost, which is called as operating leverage. Another risk arising out of interest, that's called as financial leverage. And in any business, the combination, sometimes operating leverage may be more, financial leverage may be less, or both are more. Like that, the combinations we are going to analyze, and we have to understand what impact it will have on the profitability. So these formulas to remember: first, prepare an income statement in a marginal costing fashion. Sales less variable cost, you have contribution. Contribution less fixed cost is a profit before interest and taxes. PBIT or EBIT, I, and earnings before tax, and tax, earnings after tax. Here, you please see that contribution less fixed cost is PBIT. So therefore, the formula for operating leverage, which arises because of fixed cost, is simple: contribution divided by PBIT. And the financial leverage arises on account of fixed interest. Therefore, PBIT divided by PBT, and that is equal to the operating leverage, financial leverage. That is the first step. So we have given you one problem so that you can compute the degree of operating leverage and all. Now friends, suppose contribution is 1 lakh and fixed cost is 10,000. PBIT is 90. So here the value of operating leverage is 1.11, whereas the second case 1 lakh, 90,000 and 10,000. Fixed cost is 90,000. So that is called as financial leverage. Operating leverage, that is 10 times. So what do you understand here? Operating leverage, if it is 10, means 10 minus 1, 9 will be fixed cost. Operating leverage 5 times, it means 5 minus 1, fixed cost will be 4 times. That is the first step. A high value for operating leverage represents high fixed cost. A high value for operating leverage represents high fixed cost, high risk. A low value for operating leverage represents low fixed cost, low risk. This is what you have to understand. So I repeat, if operating leverage is given as 5, fixed cost is 4. If the financial leverage is given as 6, the interest is 5. That is 5 by 1, 5 minus 1. You can see that format there. So we go to the next problem. First understand. So far we have understood there is what is called as operating leverage. It is a risk arising on account of fixed cost. It is an uncontrollable risk. It is also known as business risk. Second risk that arises on account of interest is known as finance risk, and it is controllable risk measured by degree of financial leverage. Point number 2, we have explained the profit statement, how that income statement is prepared. Then now we also have discussed how to remember that formulas. Next, third one, a high value for leverage represents high risk, high incidence of fixed cost or interest. Next, another point, we said that if operating leverage is 4 times, in figure our fixed cost will be 3, 4 minus 1. Now take this problem number 2, where you find that variable cost as a percentage of sales is given as 50%. Interest expense is 20,000. Degree of operating leverage 3 times. Degree of financial leverage 2 times. Income tax 30. So how to solve this? You are supposed to prepare the income statement. Students must remember, first put the format. What is the format? Sales minus variable cost. You get contribution. Sales minus fixed sales minus variable cost, contribution. Contribution minus fixed cost, profit before interest and tax, interest, profit before tax, everything is before you. In this problem, it starts with the interest as 20,000 X and financial leverage is given 2. So 2, 1. 2 minus 1 is 1. 1 is equal to 20,000 or 2x, 1x, 1x, either ways. So 1x is equal to 20,000. 2x will be 40,000. So we have got that. Then using that we can calculate the fixed cost. Operating leverage is given as 3 and 1. That means 1 is equal to 40,000. So 2 will be 80,000, 3 will be 1,20,000. So contribution will be 120, fixed cost 80, PB 80, 40. Please check it out. Now he is given that say variable cost is 50% of sales. That means if sales is 100, variable cost is 50, then contribution is 50. So 50 is equal to 120,000. 100 is equal to 2,40,000. That is the point. So I request you to do the second problem also in the same manner, and I have also given you another simple problem for you to do. In the third problem, we are now going to understand what is combined leverage, how to interpret these things. Friends, we all are seeing that there is an economic recession, and you find that in software a lot of people have lost their employment. Business is subject to a lot of fluctuations which we cannot predict, as just explained in the introduction. So if you analyze many people who have expanded too much, they have just like a bubble, they burst because they did not have a proper balance or cushion. Suppose, for example, I open branches in, I expand real estate, construction and investments, like that, wherever opportunities come. But suppose like a recession comes, suddenly struck, then I cannot close the business immediately because I hope I will recover everybody. But during that period of recovery thinking, you have to pay the fixed cost. Many companies, after hoping that they will do well, they continue to pay the fixed cost which has become loss and wiped out their capital. And again they go on borrowing to supplement that payment of fixed costs. Then the finance risk also is increased, and as a result the business collapses in just no time. When the business is steady, the sales are good, you can take risk. But when there is an uncertainty in the business, we should be very careful. Always you have to make best use of the fixed cost and try to reduce the financial leverage. And though initially if your sales are very good, we can go for high risk, then you will make good profits. But sooner or later, the financial leverage should be reduced so that the interest commitment will be much lesser. Make best use of the fixed cost. That is the concept that we are going to understand. We understood in this leverages. And now we are going to talk about this indifference points.